Hi everyone, this is Ben Ryan and I'm here in the studio with macro analyst Christian Drake. We got some important data from the Federal Reserve this afternoon, consumer credit. We're going to talk about that alongside our call on our employment and peak consumption calls. Very important to look at credit growth alongside those two things. Christian, I'll just let you dive right into it.
Yeah, thanks, Ben. So we did get the April update on consumer credit today. I think it's a little bit of an underappreciated metric, at least in terms of how much airtime it gets. But just to quickly set the stage before we get into the data, we are a consumption economy, and there are really only two primary ways to spend. You can make what you spend. You can spend what you make in terms of income, or you can spend what you don't make in terms of credit growth. Now, we've profiled this a number of times, but what you make is driven by the trend in employment, hours worked, and how much you make per hour. That defines aggregate income growth. So as a country, what we earn as a country in terms of salary and wages defines our capacity for consumption, and that's pretty straightforward, right? So just the first couple charts here, I guess if we can get into them, we showed these in our 2Q themes presentation. Just first chart here, employment growth. So again, we're past peak in terms of the employment cycle. It's not a harbinger for immediate end of the economic cycle, but we are past peak, and the cycle's going to play itself out to the downside. So we peaked in the first quarter of 2015 on the employment side, and the natural corollary to that, if we look at the second slide, is aggregate income growth peaked at around the same time.
Yeah.
And then which we don't have the chart here, but if you look at consumption growth peaked in the first half of 2015 as well. So we're past peak in terms of employment, in terms of income, and in terms of consumption growth. Next factor again, which we got today, was the credit numbers.
Yeah.
So again, the pace of, if income and employment are both decelerating, the pace of consumption growth can only be maintained if credit growth accelerates and kind of fills that gap, right? So
and the point is just that people are going to spend money if they have it, right? And whether it's money earned or whether it's money given to them through credit, they're going to spend it.
Right.
And that's the idea.
That's the idea. And if you look at the multiple correlation between income growth and consumption growth over decades of data, it's super tight, right? Yeah. So you have your income growth numbers, then the only swing factors inside of that are what does credit growth do, and how does the savings rate oscillate as income growth
makes
moves.
Sense.
So if we look at the actual credit growth numbers here, there's broader aggregates for credit growth. What we're showing here is revolving credit growth. That's credit card debt.
Yeah.
Look, it tends to be outside of recessions where people have to use credit cards to consume because they don't have any income.
Yeah.
It tends to capture the broader state of domestic consumerism, what's going on with credit card growth. So if we look at the trend here in the chart, so you can see after basically flatlining for almost 3 years at around 1% coming out of the recession, credit card debt, or growth in credit card debt, inflected in, call it 2Q14, and has been accelerating now for around 2 years. What we saw, growth peaked at plus 6.01% in March, so last month, and then decelerated to plus 5.48% year over year in the latest data. So still positive.
Yeah, it's no small amount.
No, well, that 53 basis point deceleration was the fastest sequential deceleration we've seen since January 2010.
Oh, wow.
Now this data is a little bit volatile from month to month. It's subject to some pretty significant revisions, but the deceleration is notable, particularly if it continues.
Yeah.
If we put this into some further context, so typically what we see is growth in revolving credit track the change in household consumption of durable goods, which it makes intuitive sense. Consumers, I guess, disproportionately use credit cards for higher ticket discretionary purchases, which are durable goods.
Yeah.
In this chart here, we just kind of broaden the scope and look at revolving credit growth relative to total household spending. And again, this is just the previous chart with total household spending plotted on top of it. There's basically a couple points of note here. You can see the two series crossed over in early 2015 with credit card debt continuing to accelerate while spending largely flatlines, total consumption flatlined. And
is that what it looks like? Now, is this cyclical? Does this usually happen in most cycles? Does spending start to roll over before credit card growth starts to roll over?
Well, it varies, but you can say something very discrete about credit growth. So credit growth is classically pro-cyclical. So as consumers feel more comfortable about their job and income positions, they're more likely to use credit. And for lenders, as income growth improves, their capacity for debt service improves. And when you have an expansion, especially one that's matured for a while, asset values have usually gone up. So the collateral backing the loans also improve. So
it's all pretty straightforward when you explain it like that.
So it's credit is pro-cyclical, and that's what you see. But what we want to say in the chart here is that total spending has flatlined, right? So we've needed to see accelerating credit growth just to maintain a flat trend in consumption growth as aggregate income growth has trended lower. So I think that's an important point. And then lastly, if we put it, I guess into, pull the curtain back even further on the time series, what kind of capacity do we have for further credit growth? And here we're showing household debt to GDP. You can see we peaked in 2008, and then through a combination, you can call it organic deleveraging plus foreclosures plus write-offs and that kind of thing. We've basically come down 19.3% down to 78.3% as of the latest data in 4Q of 15. So I guess the takeaway from a longer term perspective is pretty straightforward, but it is duration sensitive. So consumers do have some runway to ramp debt supported consumption growth if they so choose. But we're not in position to see credit growth run at a premium to income growth for a sustained period of time, particularly with income growth decelerating. What we think is late cycle, and with rates already at 0%.
Yeah, that's what I was going to say. How much capacity is there to kind of extend credit any more than what we've already seen, considering rates are already near zero, I guess.
Right, and I mean, again, there is some modest runway for it. It's hard to call on a month-to-month basis, but from a trend perspective, there's not a lot of runway to see that kind of, at least certainly not another credit cycle. And look, we only have 1 month of data here, but in terms of the revolving credit growth that we showed. But the point is, if that deceleration continues, credit growth could shift from being a marginal support to consumption growth in the face of declining, slowing employment and declining income growth, going from a tailwind or a marginal support to a marginal drag, which is the point. Yeah,
that's something to watch. We'll have to keep an eye on that. Definitely moving into the summer and then into the fall.
Right,
it's going to be important. All right, thanks, Christian. Thanks, everyone, for tuning in. If you have questions about any of the data or any of the slides discussed, go ahead and hit Hedgeye back on Twitter, or Christian's Twitter handle is Hedgeye USA. Thanks for joining us.